Good morning, or good afternoon, or good evening, wherever you are tuning in from today for today's webinar. The topic today is the UK stamp duty and tax webinar. There have been a lot of changes just recently to the UK stamp duty, and we wanted to highlight some of these and other benefits revolving around the tax. So my name's Richard Lowe. I'm the head of IP Global here in Singapore. And I'm also joined by our guest speakers, who I'll introduce in just a moment. Today, and this slide, you'll see the agenda that we'll be going through. For the first few minutes, I'll just be providing a brief overview to IP Global and our business model. Then we'll go into the main part of the presentation, which will be an update on the UK property taxes, which will be by Chris Brown from Lutia Advisory Services. Thereafter, we'll be going into the benefits of investing in property via a company structure by Chris Frame from GetGround. And at the end, we'll go through a London property case study, the Solarium, which is one of the new projects that we've launched in London. And we'll wrap up at the end for a Q&A. So all being well, the presentation should finish within about 45 minutes. So to give a brief overview to IP Global, we've been around now for about 15 years. We have 13 offices in 8 different countries, and we've done approximately $3 billion of property transactions in over 30 different markets. So in essence, IP Global positions itself as an investment company first and foremost that uses real estate as the asset class to help generate wealth for our clients. And in summary, really what IP Global aspires to do is help our clients add well-researched international real estate to their investment portfolio and make that as easy as adding any other recognized asset class. So we pride ourselves on what we refer to as an end-to-end service, and that starts with intensive research and due diligence. Our head office in Hong Kong has a research team, and they use a very methodical way to research properties all over the globe, listing some of the top performing cities, then going into a suburb of those cities where we see a strong and compelling investment story. Thereafter, we then look for the right developer to work with and ensure that they have a good track record. Once we've got to the point where we believe that this is a compelling investment with a good developer, we actually co-invest or underwrite. And what that means in layman's terms is we do a bulk purchase and buy over either the whole development or a significant number of units within that development. So effectively, we have skin in the game and we share the risk. Basically, with the clients are typically looking for a good quality investment with low risk. IP Global has to find a compelling investment, otherwise no one would buy it off us. IP Global, basically, if we haven't sold all of the properties by the time it's completed, or in Singapore jargon, TOP, IP Global is legally bound to buy over those properties. So we have a vested interest to make sure that these are compelling investments. Now, once you've decided to invest in one or more of the units of one of our projects, we have an end-to-end service that helps you through the whole process. So we would introduce you to the lawyers to get the conveyancing started. We have our own in-house mortgage brokerage to assist with accessing financing. And as we get closer to the completion, we have our own in-house property management company that will be able to do a full service from finding the tenants, managing the property, collecting the rent, and even assisting with reselling the property at some stage in the future. So a little bit of a background and overview to IP Global's track record. Although we've been in 30 markets over the years, here you can see 4 different countries that we've had a fairly significant amount of investment: the USA, Australia, Germany, and the UK. Within the UK, it's been arguably our strongest market with a little under $3 billion of property transactions. So that's a brief overview for IP Global. I'd like to now forward and introduce Chris Brown from Lutia. Next slide.
Thank you, Richard. Hello, everyone. My name is Chris Brown. I work here in Singapore for Lutia Advisory Services. I'm now going to talk you through some changes in the UK in relation to taxation of UK property. Basically, this is split up into 3 sections with a couple of subsections. First of all, stamp duty land tax. Due to COVID-19, there's been a temporary concession brought out by the UK government, Her Majesty's Revenue and Customs, to try and infuse the market and incentivize people to purchase property. That applies right now and has a short-term deadline. It's temporary. And then there's the surcharge for non-UK residents, which is another stamp duty land tax, which is taking to the other side of the spectrum, actually making an increased charge of stamp duty land tax for non-residents buying UK property. Then at the end, I'll just touch on capital gains tax. There's the non-resident CGT capital gains tax regime for non-UK residents who sell property in the United Kingdom. There have been some adjustments to that in relation to paying up within 30 days. And there's also been a few changes to the corporation tax on capital gains of people who purchase and sell properties through companies in the UK. There's been an alignment of taxation. And finally, there's just a couple of points on corporation tax on company rentals, how the income is taxed. So first of all, this concession, the stamp duty land tax concession, it applies now. It came into force on the 8th of July 2020, and it extends until 31st of March 2021. As mentioned just a moment ago, the idea is to infuse the market, to encourage people to buy UK residential property. It's right now it applies a 0 rate up to purchases of property valued at £500,000 or below. It only applies to properties. If you have if it's your only property that you own, or your first property, then there's 0 rate up to £500,000. If you already own a property anywhere in the world, or it's your second or more property, or alternatively, you've taken the advice of someone like Chris Frame and you're using a company to purchase your property, then the non-standard rates, the higher rates, which have always been enforced, will apply slightly. So instead of paying 0 rate, you'll pay 3% on the first £500,000 in terms of stamp duty. So this is aimed to encourage people to go out and spend. It can be quite a significant saving for up to £250,000. There is still a saving, but it's not as significant as if you're spending £500,000, where the savings are clearly visible. At £500,000, if you're buying a property for that value, you're going to save £15,000 straight away on stamp duty, which you would have paid if you had purchased the property before the 8th of July. So this slide is about the surcharge for stamp duty land tax. It's a 2% surcharge. The idea is to deter wealthy individuals and indeed companies overseas from investing in UK property as some form of financial instrument. The market is considered by the government overinflated, and the idea of this is to try to cool that down. So it applies to residential property only, and it's property acquired in the UK from the 1st of April 2021. The rules aren't laid out in full just yet, but it's planned to happen. There are still certain things that we're not entirely sure how the government is going to work out. One specifically is that there's a residency test required upon the acquisition of the property. UK residence is a very complicated thing to calculate and to work out. And is going to require all sorts of advice on respect of the acquirer. So we have to wait and see how that pans out. But essentially, what it's saying is that you're going to pay now 2% more than you were paying before. And as noted above, we have this window of opportunity right now to acquire property up to £500,000 with 0 rate stamp duty. Next slide. So the idea, if you're going to buy a property and you've decided, or you're thinking of deciding, and it's likely to be at some point in the next year or so, there is quite a lot of merit in bringing that acquisition forward and completing on or before the 31st of March 2021, because you can actually save yourself £25,000 on a property worth £500,000. The same property I mentioned earlier, you can buy for £500,000 and at rates before the 8th of July 2020, you would have paid £15,000 stamp duty. If you hold off, you buy the same property in after the 1st of April 2021, you will pay £25,000 stamp duty on an acquisition. So there are immediate savings to be had, not just looking on what you would have paid before, but also what you could pay in the future. Next slide. So here's a comparison, a diagram just to illustrate that. You've got on the left-hand side the purchase price bands for stamp duty, land tax, 125,000, then 125 to 250, 250 up to 925,000, and then up to 1,500,000, and then for purchases over £500,000, you've got rates 0% up to 125,000, then 2, 5, 10, and 12% on the other bands. So for a £500,000 property, you would be paying £15,000 in stamp duty, land tax before the 8th of July 2020. The new rules, these temporary rates, they split the bands out slightly differently. They've just given you a 0 rate band of £500,000 if it's your only property. You can have owned property previously. It could be your first property. There are special rates and allowances for people buying their first property in the UK, which applied up until the 8th of July, but that's temporarily on hold. Excuse me. This new window applies specifically for this short period of time, and so up to £500,000 is 0%. The comparison here, we're talking about a property which is limited to £5,000, so that £500,000, so there are no higher rates. So you can see the immediate saving there of £15,000 if you buy in this window. Next slide. But the savings actually go further than that. You can see at the bottom the total cost of buying a property in a company. If you were to own a property in a company, or if it's your second property, then you, then you still make the same saving, £15,000 based on the rates before 8th of July 2020. Basically, in this instance, because it's your second or additional property, or a company is buying the property, you pay a higher rate of tax. The 0% is replaced with 3% in the prior to 8th of July 2020 rates, and then the subsequent rates are all increased by 3%. So there's a 3% additional rate to pay if it's your second or additional property, or a company's acquiring it. What they've decided to do in this instance with the short-term temporary rates is to apply 3% to the whole of the £500,000 bracket and leave the others as they are with the additional 3%. So on the same £500,000 property you might have been buying before, if it's your additional property or a company, you're going to pay 3%, which still saves you money. So there's a £15,000 saving in stamp duty, land tax in this case as well. Next slide. So this slide shows the saving that you can make looking forward. I mentioned that there's a stamp duty, land tax surcharge coming in from the 1st of April 2021. So now if you look at a £500,000 property which you acquire now for 0 rate stamp duty during this period, if you were to wait until after the 31st of March 2021 and acquire the same property, the previously applied standard rates are going to apply, but with an additional 2%. So where ordinarily you were paying 0%, 2%, 5%, 10%, and 12% on the various rate bands from £125,000 up to over 1.5 million. Now, if you wait until after April, you're going to pay an additional 2%. So on the same property, you're going to pay £25,000 in stamp duty, land tax, which is £25,000 more than you would pay now, and £10,000 more than you would have paid if you'd have acquired the property before the 8th of July 2020. So whilst you're making immediate savings on what you would have paid 2 or 3 weeks ago, if you look forward till after 31st of March, you're going to make an extra £10,000 worth of savings on waiting until that point. Next slide. And the same thing applies for second or additional properties or properties owned via a company. Here is a comparison if you're acquiring a property through a company now, or if it's an additional property. During this window of opportunity, you're going to pay £15,000, which is a £15,000 discount on the prior rates. But if you were to hold off and acquire the same property after 31st of March 2021, then the stamp duty land tax would be at increased rates, which would lead to, as you can see here, a £40,000 charge to stamp duty land tax. So that's going to save you £25,000. Acting now rather than waiting, or doing what you can to bring forward your purchase, exchange sooner if you can, and most importantly, complete the purchase on or before 31st of March 2021. Next slide. Excuse me. So in a nutshell, if you're thinking of buying, now is the time to buy. Just as an aside, if you're looking at buying a more expensive property, and you acquire a sold property for £1 million, then you make an immediate saving along similar lines at future rates of £32,750. And if you're acquiring £1 million property through a company, or if it's an additional property, then you make an immediate stamp duty land tax saving on the future rates. Otherwise, if you would acquire after 31st of March 2021 of £35,000, there will be some notes circulated with the slides where you can see the example. Next slide. So just to talk about capital gains tax, there were some changes to capital gains tax as they relate to UK property over the last couple of years. For disposals after the 5th of April 2020 by individuals, your individuals who are not resident in the UK are subject to the non-resident capital gains tax regime. That means that they need to go online and complete a non-resident CGT, NRCGT tax return. This has been in place for some time. You can do it yourself, or you can have an advisor do it for you. And the process has been that you need to, complete the return, submit it within 30 days of completion of the sale of the property. The tax could be paid at the end of the tax year on the due date for paying the rest of your tax if you do a self-assessment tax return. Well, they've changed the rules now, so from the 6th of April 2020, non-residents have to file the return online as per before, but they actually have 30 days now to pay the tax and to report everything on their self-assessment tax return at the end of the year as well. So that the new thing there is the government consider you've got the money, you've completed, you've been paid, you've paid off your mortgage, so whatever's left, they consider they due their share within 30 days. Now, it's based on an estimate of the tax due, and your actual tax liability is calculated in your tax return after the end of the tax year. So it's considered a payment on account, but it must be paid within 30 days, and if it's not paid, then you have penalties to pay, which can get up to £900 if not paid. Just to remind you, the rates of capital gains tax for individuals is 18% for the lower rate, which means that when added to your other income, the value of the capital gain doesn't go over the lower rate threshold, or alternatively at a rate of 28%. Next slide. And in relation to disposals by companies of UK residential property, disposals made after the 5th of April 2019 are now subject to corporation tax rather than company non-resident capital gains tax. The corporation tax is a rate of 19%, which generally is considered lower than the main rate of capital gains tax for individuals is 28%. So there's a saving there. So for disposals after that date, there's no capital gains tax regime. It's a case of the overseas company is treated as a UK company from tax perspective in terms of pay and file. It needs to submit a corporation tax return and disclose the gain with its income, which is all subject to corporation tax in accordance with the regular company deadlines. Next slide. And there's a new rule which has been implemented. It's coming into force. Excuse me. Now, in relation to disposals of company shares, which are what the government call land-rich companies. So where there is a company which owns 70%, 5% of its value is derived from UK land or property, then ordinarily before 2019, those shares could be sold by a non-resident and there was no capital gains tax on the sale, even though the company owned the property. The individual or the company is considered as selling shares, which is not property, and there was no UK CGT regime for the disposal of shares, UK shares. That's now changed because the company is derived essentially most of its value from UK land and property. HMRC will consider those shares which are sold as effectively as land and property value. So again, this is within the non-resident capital gains tax regime. So if I sell shares in a company which owns UK residential property, excuse me, then I need to disclose the sale of those shares as long as I've sold more than 25% of the company's shares on an NRCGT return, disclose the capital gain that I've made on the sale, and then pay tax within 30 days of making the disclosure. If there is a company which has made a similar sale, then the company sells the shares in the underlying company which owns the UK property, then it's the corporation tax return of that shareholding company which needs to disclose the capital gain and pay corporation tax accordingly. Now, this is a big change, and before 6th of April 2019, there was no capital gains tax to pay in respect of this disposal. Now there is. So there is a provision in the rules which allow the shareholder to rebase the value of those shares to the market value of those shares as derived from the underlying property. So whatever the proportion of shareholding is, that proportion of value of the company, the underlying property, as at 6th of April 2019, will be the cost base going forward. So when the shares are sold, the market value of that share of the property is deemed to be the proceeds, and then the relevant proportion of the market value of the property at 6th of April 2019 will be deemed to be the applicable cost, and any profit in the middle there is what is the capital gain. Thank you. Next slide. And finally, just to touch on the corporation tax on rental income. Rental income for non-residents was for many years just charged to income tax. You did a UK tax return, said you're not resident, you paid the tax. Where it comes to corporations, there was a special non-resident landlord company tax return which was subject to income tax. The rules changed from the 1st of April 2020, where basically those companies come within the realms of corporation tax, and just like any UK company, the non-resident company landlord needs to register with HMRC, complete a corporation tax, declare its rental income, and to pay tax under the corporation tax regime at the rate of 19%, which is a 1% benefit over the 20% they paid before. And the same rules will apply. They can continue to get relief for all expenses within the company, loan expense, for instance, on mortgages, etc. Next slide. Thank you. So that concludes my brief talk on UK taxes. I'm going to hand you out now over to Chris Frame from Get Property, who will take over.
Thank you, Chris. Thank you very much for that, and thank you, Richard and IP Global, for hosting today's webinar. As mentioned, my name is Chris. I'm the VP of Growth at GetGround. I too am based in Singapore. We've got an office here with a small team based here, as well as opened a brand new office in Hong Kong with a team based there, both of which support our headquarters based in the UK in London. So at GetGround, we specialise in setting up and then running UK registered limited companies for the sole purpose of buying UK buy-to-let property. Really key market for us, and hopefully one that can help benefit and enhance any investments that are being made in the UK property market. Sorry. We believe there is a smarter way of buying UK property, and that is through using a limited company. There are many benefits that come from using a limited company structure, and GetGround are trying to make those benefits more accessible and more easily accessible to all investors purchasing in the UK. GetGround are removing the two main prohibitive factors that have previously existed when individuals have looked at using a limited company structure. Those two being one of cost, both in terms of the setup and indeed the running costs of those limited company, and then secondly, one of time. Again, in terms of the setup of that limited company and indeed of the involvement that's often needed when running that limited company setup. GetGround, we will hear everything can be done online, all be done remotely, regardless of where you as a client or a potential customer are based. It can all be done from your side of things and set up in 20 to 30 minutes. So really quick, really simple, and very straightforward to do that. So we are looking to enable all investors to take advantage of these benefits without the high costs and indeed the hassle of the time involvement previously there. In terms of what GetGround will actually do for you, well, we will help set up and open and register that limited company with Companies House. We will then produce all of the legal documentation that is associated with that limited company, and indeed that allows that limited company to buy and hold the property. We will help you structure that limited company as per your own wishes and as per your own input. And we will also open a UK bank account for you. This is quite a key benefit, particularly for non-UK residents, whereby it can be a very time-consuming exercise to do that. So all of those encompass our setup services, and as I mentioned, all can be done online and all done remotely, with a UK limited company set up and operational within 24 hours, and 48 hours thereafter, the UK bank account being opened afterwards. Once the limited company is actually set up, we will then take ownership of all financial administration of that limited company. Okay, so we will take on a very comprehensive service for you as an investor, and that includes all accountancy matters. So it includes all of the tax filing, tax auditing, company tax returns, any of the bookkeeping services. It also involves us undertaking the company secretarial services and indeed acting as the company registered office address. So again, hopefully providing a very comprehensive service and solution that enables minimal time involvement for you as an investor. Just moving on to the next slide, just going to talk about why individuals are previously and currently looking to use a limited company. What are those benefits that come from using a limited company structure? The one that typically tends to get the most amount of attention is the increase in profits, potentially, and then the increase in returns that come about from greater tax efficiencies. And I will come on to those on the next slide, just to go into a little bit more detail where those tax efficiencies arise. But you can see on the right-hand side is a very simple bar chart, which is taken from an audited tax example that we have, and we're very happy to share this with anyone as necessary, that shows for non-UK residents a potential increase of 52 to 66% in post-tax profits, with a couple of assumptions made that assumes buying a property, holding it for 5 years, and then selling it thereafter. But there are a number of other advantages that come from using a limited company structure, as well as those tax efficiencies, and we deliberately take a very holistic view of what these benefits are, and with different benefits being having a higher weighting, I should say, to each individual client. There is a limited personal liability. So by holding a UK property in a limited company structure, you actually remove that liability from your own personal name. The limited company that we set up has its own legal entity, and that alone holds the property, and with it, all of its assets and its debts and its liabilities. And we've certainly seen, particularly in the unforeseen circumstances around COVID-19 in the last 6 months or so, a lot of investors have felt quite reassured by having their investments held in a limited company structure. It is also a mechanism that makes it very, very easy to buy and sell with multiple persons. It enables for ownership percentages to be weighted accordingly as per the inputs of the various shareholders, if indeed there are more than one. It is worth noting that those financial benefits that come apply regardless of the number of shareholders, but if you are looking to buy with multiple persons, as I said, it makes it very, very easy to actually apportionate that ownership of that particular property, as well as providing a little bit of greater protection, because one of the key legal documents that we produce is actually the shareholders agreement, and that very simply details what each shareholder can and can't do within that limited company and within that investment. It is also a mechanism that helps manage estate and inheritance planning more efficiently. Very important to note that these limited company structures that we're setting up, they are not tax avoidance schemes. They are very simple mechanisms, very simple SPV vehicles that are designed to buy and hold property. But by using a limited company structure, it can enable greater flexibility to manage estate and inheritance planning. And again, very happy to have those conversations in more detail, given anyone's particular circumstances. And then just finally, there is now a very well-developed mortgage market in place for limited company structures, which is something that's changed, particularly over the last 5 or 10 years. It was often treated as more specialist lending, whereas that is now no longer the case. In 2019 alone, there was over 30,000 buy-to-let properties made in the UK that used a limited company structure and which took out a mortgage finance. So that market is a very fast-growing area of the mortgage market. We have a very extensive network of partners, and I know so too do IP Global, and we're very happy to help arrange financing for that. But it is now very easy and very regularly available to get financing, and because of that increase in popularity of using a limited company structure, a lot of lenders have innovated and or moved into that market space, and as a result of that, that market is now a lot more competitive than it previously was. And again, very happy to have any particular conversations on each individual circumstances. Just moving on to the next slide, I mentioned about the tax efficiencies that exist from a limited company structure, and just thought it'd be well worth just to run some of these through very briefly. I appreciate Chris has touched on many of these in his presentation, but just to give a very simple overview between those personal liabilities and those of a limited company structure. At GetGround, because we are only applicable and our benefits only apply to those that are investing and buy-to-let property in the UK market, upon entry, actually the stamp duty remains the same, regardless of personal ownership and or indeed your limited company structure. Okay, so there's no real disadvantage or advantage so far. But during the ownership period, there are two key advantages that exist whilst you own a property during a limited company structure. The first of which is that you still have the ability to offset your mortgage interest from your UK tax bill. And that is quite a significant potential saving. It is worth noting that any asset in the UK that is held that produces an income, and in property perspective, we're talking about rental income and then potentially capital appreciation upon exit, but any income that is generated will be liable for income tax. Now, where this is a key advantage is that one of the highest associated costs that exist with the property purchase is that of your mortgage. So losing the ability to offset that against your potential income can significantly impact the amount of income you would be liable for on income tax. Moving on to the second point, that then feeds into that, which once corporation tax is then paid, there is now the ability to very efficiently take money out of that limited company and out of that property. For those of you that are non-UK residents, there is now 0% income tax applicable to dividend income in the UK, and that is a potentially significant advantage for any non-UK resident. It is worth noting for those that are UK residents on this webinar that income tax is applicable on dividend income. However, there is a second mechanism available to take funds out, and that is via what's called an owner loan repayment, which is also available to non-UK residents, but with it also incurs 0% income tax. The way that that works is if someone was to buy a property for £100,000 and they put down a deposit of 30% and then a mortgage for the rest of £70,000, that £30,000 deposit would be seen by the government as a loan from you as an individual to that limited company, and therefore from those profits you can withdraw that amount of money back out of the limited company without incurring income tax. So both of those mechanisms are available for non-UK residents. Typically those that are UK resident would go down a loan repayment route, and typically our non-UK resident clients would do that via dividend income, because as I say, for all non-UK residents there is 0% income tax applied in the UK. Moving on to the exit and the sale of this investment, again, there are two key advantages. Sorry, we can just go back a slide just to finish on the capital gains tax ones. So just going on to the exit side of things, again, there are two key benefits that apply from using a limited company. And again, Chris has touched upon these benefits that come particularly on the capital gains tax side of things, whereby in your own personal name, investment property now has a capital gains tax of either 18% or 28% of the gain that is made if it's held in your own personal name. Using a limited company structure, however, there are actually two mechanisms that are available to sell that property. The first of which is to sell the shares of the limited company, which owns the property, and therefore you would be also selling the property. And secondly, to sell the property out of that limited company, and both of those incur a lower capital gains tax. First of which is the sale of shares, which, as Chris has mentioned, and just to confirm, the sale of shares has with it a 10% or a 20% capital gains tax applied, subject to that income tax bracket. So on either bracket there is an 8% saving on that gain being made. So really quite a significant amount of money, particularly as we've seen from various research that we've done, that most investors tend to hold property for about 8 to 10 years on average, and which time historically that is a common time scale used for UK property prices to double. So that potential gain can be quite significant, and therefore any saving too can be quite a significant saving as well. And then just finally on exit, there is a second potential advantage as well, which only applies if you sell the shares of the limited company. But if you do that, then the incoming buyer doesn't actually have to pay stamp duty tax on that purchase. Now that gives the seller one of two options. Firstly, you could potentially increase your price slightly to try and increase the gain that you are making. Secondly, you'd actually create a price advantage in the market, because any other property that was being sold at that same price would likely incur stamp duty. So one of two options is available there if selling the shares of that limited company. That really finishes my brief presentation. I'm very happy to answer any questions, which I think we're going to come on to. So I'll pass back on to Richard, and we'll go from there.
Great, thank you very much, Chris. Really what I want to wrap up with is how some of these things would apply to an actual case study of a property in London. We've heard a lot of facts and figures, and for people who are not in the industry or tax consultants, it might be a little bit overwhelming, but then again, that's why we have the expertise who will be here to answer questions, as well as be available if you have questions thereafter. I'd like to meet up if you're based here in Singapore. So, next slide. We've recently launched a property in Zone 3 in London called the Solarium. It's in the area of Brentford, and the actual project itself is right down here in the bottom right-hand corner. We can see a huge regeneration program that's going on just north of the River Thames, and this is Kew Bridge, and on the other side of the river, we're getting to the famous Kew Gardens area. Next slide. So what's happening in the Brentford area? There is an area referred to as the Golden Mile. And this is a stretch along the M4 corridor, which is a major road coming in from the west of England into the centre of London. And this Golden Mile now is home to over 200 multinational companies. When IP Global is looking for properties, one of the key things we're looking for is where will the tenants be coming from? And you can see the Solarium project here lies right in the heart of these multinational companies. In fact, there are blue chip headquarters in Brentford, which include companies like GlaxoSmithKline, Sky, Sega, and Allianz. And the overall regeneration program that's going on beside the river is over £500 million worth of investment. Next slide. So the project itself, IP Global has taken on 32 of the top floor penthouse units, all coming with balconies. As mentioned, it's in Zone 3, it's about 35 minutes to travel into central London, 15 minutes to Heathrow Airport in the other direction. The developer is Paradigm Land, and yields are expected to be up towards 4.6%. And price points for Zone 3 start at 371,000 to 550,000. Now, one of the reasons why IP Global decided to take on this project was the research that was coming out about what tenants are looking for in a property post-COVID-19. Things like having access to outdoor space. So having a balcony or a terrace is seen as a key thing if you're going to be working from home for multiple days throughout the week. Having access to parkland, of which Gunnersbury Park is literally on the doorstep, and over 180 acres of parkland right there to enjoy. Things like having high-speed internet and also having co-working facilities, all of which are provided in the clubhouse of this project. Now, there are some additional savings, as we've touched on through the presentation today. There are savings of £15,000 based on the stamp duty. IP Global is actually selling these units with an additional £15,000 below market price as well. We're offering for the first few buyers a free furniture pack and also 30% discount on the letting and management fees. So some nice perks for anybody who's looking to invest. Payment plan is as follows: 10% on exchange of contracts, 5% 6 weeks later, a further 5% 12 weeks later, and then 80% on completion. Next slide. So let's see how that really relates to an actual property. Putting the things that we've heard about today, what are those actual savings? So let's take that property. We have properties, as I mentioned, in the Solarium from 371,000 to just over 550,000. So let's take the example of a property that is actually at £500,000. What am I going to save taking advantage of this window of opportunity through the latest stamp duty holiday? So first of all, we're going to save £15,000 by buying before the 31st of March. Also, by buying before the 31st of March of next year, we're going to save an additional £10,000 because there will be an additional 2% stamp duty that comes into effect from April of next year for non-residents buying into UK property. So that's a total saving of £25,000 on a £500,000 apartment by buying before the 31st of March. Now, as mentioned just earlier, IP Global has provided a £15,000 discount on all of the units from the market price. We're offering a free furniture pack, which is equivalent to a value of about £10,000. And the saving in the management fees for the first 2 years is in another £1,400. So really, in real terms, the savings on an investment at the Solarium at the moment, when you add up those different sums, comes to £51,400. Now, something we haven't touched on, but I'm just going to briefly bring it in because I think it's a major impact to why is it that IP Global are now going back into London. We've done almost 100 properties in our 15 years in IP Global. We haven't been in London for 3 years, and the primary reason is we felt that after Brexit, we saw that London prices were going through a correction. However, we feel that that is getting close to bottoming out, and from a timing point of view, we've seen that prices may go down a little bit further, but may have bottomed out. But there are some other very significant factors that make it a compelling investment. First of all is the exchange rate. Just prior to Brexit, the exchange rate was approximately 2.2 Singapore dollars to the pound. So that would have made the purchase of a £500,000 property £1.1 million prior to, just before Brexit. When I took the exchange rate of the Sing dollar to the pound sterling over the weekend, it was at 1.75 Singapore dollars to the pound. That would actually mean that the same property, instead of being 1.1 million, would cost £875,000. That's a total saving in Singapore dollars of 225,000 Singapore dollars, or in pound sterling, approximately 128,500. So just in the FX exchange rate, there is a major benefit. One of the other things that's come out of COVID-19 is interest rates, and typically globally interest rates have gone down around the world. In the UK, the English base rate is now at 0.1%. Now that's a 300-year low, and certainly in my lifetime, it's making mortgages one of the most attractive times to lock into access to financing. So when we combine the things like the savings that Chris Frame has spoken about by buying a property through a company structure, the access to cheap financing in the UK at the moment, the exchange rate, the stamp duty, as well as some of the additional bonuses, there really has been no better time to invest into London for many, many years. So that really wraps up the presentation today. If we can just go to the next slide. What I'd like to do is thank everybody who's joined the seminar from wherever you are in the globe. But before we finish, I do have some questions that have been forwarded in advance and some that have come through that I'd like to pose to the guest speakers and let them answer some of the questions that we've had coming in. So I'm going to start off with Chris Brown. These are a few questions directly relating to taxes, and maybe some of them that we hadn't necessarily covered in the presentation. So is personal tax higher than corporate tax in the UK?
Thanks, Richard. Personal tax is levied at tiered rates. Corporation tax is at 19%. It's a flat fixed rate charged to companies based on the profits chargeable to corporation tax at the end of the year. Personal income tax rates, they're varied. So first of all, there's a personal allowance for people who are resident in the UK or not resident, but carry a UK passport. They get a tax-free allowance of £12,500. Anything after that, then it's 20% and then 40% and then 45%. So the first bracket is from zero for non-residents without a UK passport up to £37,500, and that's at 20%. And then from £37,500 up to £150,000, the rate is 40%, and then over £150,000, the income tax rate for individuals is 45%.
Lovely, thank you. And what is the inheritance tax in the UK at the moment?
So inheritance tax is a death duty. It's at 40%. It's applied to the estate of someone who dies. If a non-resident, non-British person owns UK property or UK shares, any asset situated in the UK, then they're potentially within the scope of UK inheritance tax, and the death rate is 40%. There is a nil rate band exemption, which is £325,000. So the first £325,000 of the death estate is subject to a zero rate, and thereafter the rate is 40%. There are exemptions, Richard, spouse exemption if you're married to someone. Also, if you own a business, there are certain other exemptions, and gifts exemptions. You can go back a couple of years for certain gifts that you make. But essentially, if you've got an asset in the UK, you're potentially within the scope for inheritance tax, and the rate is 40%. So it's worthwhile taking advice to see if you can mitigate that.
Excellent. Okay. And last question for Chris Brown, rather open-ended question. Let's see if we can see if there are any gold nuggets. Do you foresee any other changes to taxes relating to UK property in the near future?
Well, yes, talk about a loaded question. What I can guarantee is that tax rates, tax reliefs, tax allowances will change in the UK. They change every year. There's a Finance Act, there's 1 or 2 budgets every year, and the UK government loves to tinker. Will there be a global tax such as America has, for instance? Who knows? I mean, it's a difficult question to answer. I've seen in the press last week that the UK Chancellor is taking a stern look at the UK capital gains tax legislation currently. So there are murmurings that UK capital gains tax could go back up to 40%, as it was 20 years ago, but you had an indexation allowance then. Now you have no other allowances. So yes, definitely there'll be changes. They need to incentivize people to continue to incentivize people to invest in the UK, but B, they've got to pay for the COVID-19 bailout. So we have to wait and see.
Okay, great, lovely. And a few questions for Chris Brown from GetGround, relating more to the acquisition of property. So, Chris, when is the best time to set up a company when buying a property?
Yeah. As soon as possible is probably the simple answer. In the simplistic format, it's sort of buying a property today or agreeing a property price today and a purchase today, setting up the limited company, and then looking to exchange contracts in that company and then move forward to completion. That being said, anyone who has exchanged contracts and not yet completed, all of the benefits that we've talked around previously do remain, with the only small exception that it'll likely be a small legal fee charged by your solicitor to amend the contract from your own personal name into that of the limited company name, if that was something that would like to happen. So anything pre-completion is very, very straightforward and very easy to do. Anything post-completion, it's actually relatively easy to do, but it's very difficult to justify. And the reason for that is that the UK government would see that as a sale from individual to limited company, and therefore there would definitely be stamp duty rates applicable, albeit lower rates as we've touched upon right now, and potentially capital gains tax subject to when that property was purchased and indeed the performance of the market. So really post completion, it's very difficult to justify setting up a limited company, but anything pre-completion is any time, and the easiest scenario is to do so before exchange of contracts.
Great, lovely. And next question, how is GetGround able to set up so quickly and cheaply compared to other companies offering these services?
Yeah, it's a question we get asked quite a lot. The key, there's 2 fundamental reasons as to why. The first of which is that we are a technology business at our core. We have spent over £1.5 million building the platform that we utilise. As I said, it can all be done online, all done remotely, and we've agreed various processes with the regulatory bodies, the compliance bodies, the due diligence bodies that allow that process to be completed very, very quickly. That platform is further supported a little bit because one of the investors, or one of our key investors, is actually the UK government. They have invested money into GetGround for a couple of reasons. Firstly, they quite like what we do. They like that transparency and that trust that we are bringing to the world of limited company structures, and that comes from the reason that our limited company structures can only buy and hold UK buy-to-let property. But also it comes from them very keen to further professionalise and regulate the buy-to-let industry. I think that's something that we're seeing a lot more of over the last few years. So that has encouraged their investment into GetGround, which has certainly been beneficial. And as a result of that, it's enabled our platform to plug into, at the front end, into Companies House, which is where the creation aspects happen. And then at the back end, it allows us to plug into HMRC, which is the UK tax division of the government. And that has allowed us to further automate a lot of the processes that typically are in place. And therefore, we're able to run these services at a lot lower cost, which in turn, we then pass on to our customers. So really, it's the use of technology. And equally, that's been further helped by that investment from the UK government.
Great, love it. And last question then for today, is it harder to sell a property in a company structure?
It's a great question. I think, again, that actually comes back a little bit to my previous point around the trust and transparency that GetGround are actually trying to bring to that marketplace. So what we are hoping for and what we foresee is that selling a limited company that is a GetGround limited company will actually be very straightforward for one of two reasons. Firstly, that limited company can, as I've mentioned a couple of times, only have bought and held that property, and therefore that is its only activity that it can have undertaken. The legal documentation that we produce and create for all limited companies, and indeed that allow them to buy and hold property, have very strong, very high quality legal documents. They've actually been verified by CMS Law, who are a global prestigious law firm, and actually the lawyers are part of the UK government. So we're hoping that with that trust and that transparency, that it will be very, very straightforward for incoming buyers to buy a GetGround limited company with full confidence and full clarity in a way that perhaps hasn't always been the case when limited companies, as well as buying and holding property, have also undertaken various other activities, whether in the UK or indeed internationally. So I think that's something that is changing, and hopefully with that greater transparency and regulation that we're bringing to the marketplace, that will become far less of an issue.
Great. Thank you very much. Okay, well, thank you very much to our guest speakers today. So again, it was Chris Frayne from GetGround and Chris Brown from Lutia Advisory Services. We appreciate you spending your time today listening to the update on some of the aspects of stamp duty and tax changes in the UK, as well as how to buy property through a company structure. If you do have any questions, please don't hesitate to email to IP Global. My email address is there at the bottom. And also, if you wish to have a recording or a copy of the slides, please let us know and we'll be happy to forward that through. So I'd like just to wrap up again. Thank you very much. Stay safe wherever you are on the globe, and we look forward to keeping a connection with you. Thank you and goodbye.